America's average monthly income is around $5,000, and most people believe they need at least $1 million invested to generate that kind of income in retirement. But what if I told you that you could start building toward that goal with just $1,000 without ever selling a single stock? This video is about the minimum amount you actually need to begin creating passive income through Fidelity Index Funds. And the truth is, it's probably less than what most people spend on a short vacation. I'm going to show you how to build a dividend focused Fidelity portfolio that could eventually cover your living expenses entirely. I'll also explain the biggest mistakes people make with dividend investing and why I chose specific index funds for long term income and growth. But before we get into the numbers, let's talk about why index funds, even the boring ones, are one of the smartest ways to build wealth for the average person. When most people think about getting rich, they imagine buying rental properties, picking winning stocks, or throwing money into crypto hoping it explodes. And yes, those strategies can work, but they also come with massive risk, stress, and far more effort than people expect. Real estate is expensive. You need large down payments, deal with tenants, repairs, and constant maintenance. Stock picking feels exciting until one bad earnings report destroys your favorite company. And crypto, most of the time it feels like a roller coaster with no seatbelt. Index funds work differently. They're low cost, diversified, and simple. Instead of betting on one company, you own hundreds of companies at the same time. That spreads the risk and reduces volatility. You don't need to constantly watch the news or panic every time the market drops. You invest, stay patient, and let time do the work for you. No, this strategy won't make you rich overnight, but over time, it can quietly build serious wealth. And now here's where most people make a huge mistake with dividend investing. The moment they hear the word dividend, they think find the highest yield possible. A fund paying 7% or even 10% sounds amazing, but high yields often come with high risk. In many cases, the market simply doesn't trust those companies to grow long term, and if the dividend gets cut or the investment crashes, that safe income disappears instantly. That's why smart investing is not about chasing the highest yield. It's about focusing on total return. And total return comes from three things: dividend yield, dividend growth, and share price appreciation. What matters isn't just how much income you make today. What matters is how much that income grows over time. For example, a fund paying a 2.5% dividend that increases its payouts by 15% every year can outperform a high yield fund that never grows. Why? Because compounding multiplies your reinvested dividends year after year. That's how real passive income is built. But to make this work, you need the right index funds. And this process is not about chasing hype or reacting to market headlines. It's about building a reliable system that's designed to grow steadily for decades. Now, at this point, you might ask, why not just invest in the S&P 500? And honestly, the S&P 500 is an excellent strategy for long-term wealth building. It gives you exposure to the 500 largest companies in America and has delivered strong historical returns for decades. But there's one important problem. If your goal is to live off dividends and generate consistent income, the S&P 500 may not be enough. For example, major S&P 500 ETFs like SPY, VOO, and IVIVA currently produce an average dividend yield of around 1.27%. So if your goal is to generate $60,000 per year, about $5,000 per month, from dividends alone, you would need approximately $4.72 million invested. Even with a 30-year investment timeline, you would still need roughly $750,000 invested just to reach that income target from S&P 500 dividends. Why? Because these ETFs are designed primarily for growth, not income. Most of their returns come from rising share prices rather than regular cash payouts. That means if you want to live on that money, you eventually have to start selling shares, and that approach is not always predictable or sustainable long term. The portfolio I'm building works differently. It focuses on funds that offer solid starting yields, strong dividend growth, and healthy appreciation over time. So your money doesn't just grow in value, it also creates an income stream that keeps increasing year after year. And here's the most important part: you don't need to sell your investments to support your lifestyle. Instead, you build a passive income engine that keeps paying you consistently without slowly destroying your principal. That's exactly why this strategy works. You don't need millions of dollars. You simply need the right mix of funds, a solid plan, and enough patience to let time do the work. So, how is this portfolio actually built? Everything starts with three key elements: dividend yield, dividend growth, and share price appreciation. These three factors create the foundation of the entire system. You want a portfolio that pays you today, grows that income over time, and also increases the value of your investments in the background. When all three work together, you're no longer just investing, you're compounding toward financial freedom. To make this work, I selected five Fidelity Index funds that each play a different role inside the portfolio. The first one is the Fidelity Mid Cap Index Fund, FSMDX. This fund acts as the portfolio's income grower. It offers around a 2.27% dividend yield and has increased its dividends by more than 23% over the past decade. Combined with strong price appreciation, it creates a powerful long term foundation. Next is the Fidelity Zero Extended Market Index Fund, FZIPX. While its dividend yield is lower, its strong dividend growth adds diversification and balance to the portfolio. Then comes the Fidelity Zero Large Cap Index Fund, FNILX. This fund is built around large, stable companies. It offers roughly a 1% dividend yield while delivering strong dividend growth and impressive long term appreciation. The Fidelity Zero Total Market Index Fund, FZROX, adds more aggressive growth potential. Its yield may not look very high, but its strong growth rates accelerate compounding without dramatically increasing the overall risk of the portfolio. And finally, there's the Fidelity US Sustainability Index Fund, FITLX. This fund adds a sustainability and ESG focused component to the portfolio. With solid dividend growth, steady appreciation, and long term stability, it helps strengthen the overall balance of the strategy. When combined, this portfolio delivers an average dividend yield of about 1.36%, dividend growth close to 19.62%, and roughly 9% annual share price appreciation. Now, let's get to the most interesting part. How much can this portfolio actually grow over time? Let's start with the smallest possible scenario. Imagine you begin with just $1,000 invested. No huge inheritance, no massive salary, just a realistic starting point that most people could eventually afford. Then imagine adding only $1 per day. That's about $30 per month or $360 per year. Slow, but sustainable. Most people would never expect small amounts like this to create life changing results. But this strategy isn't about getting rich quickly. It's about how compound growth can turn small beginnings into massive long term outcomes. Here's how the projections play out. By the end of the first year, your portfolio could grow to around $1,466. It may not seem huge, but it's a strong start. By year 10, your total contributions would be about $4,600, while your portfolio could already reach roughly $9,183, nearly doubling your money. By year 20, you would have invested around $8,200 in total, but the portfolio could grow to approximately $45,287. Imagine consistently investing for 30 years while reinvesting every dividend along the way. That original $1,000 investment, combined with small but steady contributions, could eventually grow into a portfolio worth around $441,188. At that point, the portfolio could generate approximately $79,729 per year in dividends. That's about $6,644 per month in passive income. Most of that growth would come from reinvested dividends and long-term share appreciation. If you enjoyed this video and want to see more content like this, don't forget to subscribe to the channel and turn on notifications. Every week, I share powerful videos about investing strategies, passive income systems, and long term wealth building that can completely change the way you think about money and financial freedom. The next video could shift your mindset, improve your financial future, and help you build a stronger life step by step.